SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF BIS ECB Bank of Finland workshop on AI in central banking. Recent and forthcoming advances in artificial intelligence are also opening many avenues through which central banks' work will be affected. For instance, artificial intelligence affects the functioning of the economy, including effects on the labor market, on productivity and inflation. It affects the functioning of the financial sector, implying effects on the transmission of monetary policy, as well as posing potential new challenges for financial stability. It affects the collection, management, use, and visualization of big data sets of various kinds. It amplifies economists' ability to process large amounts of information, helps in generating and estimating economic models, and in drafting economic research, analysis, and briefings. It may affect the way financial institutions are supervised. Today's workshop brings together leading experts to provide an introduction and overview of how AI is about to change central banks' work, structurally and on a day-to-day basis. What are possible use cases? What are opportunities and challenges, including data privacy, reliability, and robustness, which generative AI may offer and pose for central banks? Before we start, let me express my special thanks to Deniz Igan from the BIS, who is also SUERF's Vice President and who will moderate our workshop today. And my thank also goes to Juha Kilponen and Mathieu Darac-Pariès, who helped design this workshop. Without further ado, over to you, Deniz.
Thank you, Ernest. Thanks everyone for joining us. We have a great lineup and very interesting issues to discuss. I'll just take maybe 30 seconds on the ground rules. We have the 4 presentations in the order that you will see in the program. So Anton will go first, and then we're going to have Jón, Sebastian, and last but not least, Maximilian. With no further ado, Anton, floor is yours.
Thank you very much, and I'm particularly honored to speak at our webinar today because I have some long-time connections to SUERF. When I was an exchange student in Belgium in the late 1990s, the advisor of my master thesis was Baron Lamfalussy, who was one of the founders and the first treasury of SUERF and regularly referred me to your work. And then second, when I had just completed my undergraduate studies and worked as an RA at the Austrian Central Bank, one of my first jobs was to create the first web page of SUERF, which I think was in operation for about 10 years or so. So I cannot tell you how honored and overjoyed that young man who created the first web page would have been if he knew back then that he was going to be invited to give the first presentation at today's conference. So let me turn into our material. Can you see the slides?
All good. We can hear, see very clearly.
Perfect. I will start by talking a little bit about the state and trajectory of generative AI and focus on some use cases and implications for economists and particularly central banks. And the first thing I want to observe is that we are really on a trajectory of exponential progress. This is perhaps a little bit hidden by the fact that ChatGPT has suddenly created all this buzz around AI after its launch in November 2022. But those of us who have followed the progress know that progress in deep learning has been going on for more than a decade. It has really taken off in the early 2010s. And at the same time, I believe it is true that generative AI, and in particular large language models, LLMs, define a new paradigm. So what is behind this exponential progress? Well, first, there is, of course, Moore's law, the capacity of chips doubling every 2 years. But that's really nothing compared to what we have seen in terms of progress of AI. What has happened in the space of the most advanced, the most complex AI systems is that the amount of training compute, which is essentially the total amount of computational resources that have been employed by these cutting-edge AI models, has doubled every 6 months for the past 15 years now. So this is much faster than Moore's law. And in addition, there are studies that show that the algorithmic efficiency with which AI has been using those computations has been growing at a rate of 2.5x per year. So if you multiply those two together, doubling every 6 months means quadrupling every year. 4 times 2.5, that means the effective amount of computational resources going into training our leading AI systems has grown by a factor of 10 every single year for the past 15 years. And we are now at the stage where the complexity of our leading AI systems is quite close to the complexity of our human brains when you measure them through the number of neurons, number of connections, and so on and so forth. So I first want to make this a little bit more hands-on, and I want to talk about how to work with generative AI and what that requires. Because in some ways, I think that's like the million, or if you're Sam Altman, the $1 trillion question of the day. Of course, the first thing it requires is access to the most cutting-edge systems. And I will get back to that in a few minutes because I think we have some problems on that front in Europe. It requires knowledge on how generative AI works. And I suppose part of what we are doing in this workshop is we are working on that. It requires learning from examples, from experimentation, but also a change in our workflows. And finally, a focus on our comparative advantage, as David Ricardo already taught us some 200 years ago. The AI is becoming increasingly good at generating content. Our role as humans is to steer and evaluate that content creation. And if you are complementary to something that's becoming better really fast, that means your value added also rises fast. So as some starting advice, there's been a lot of attention paid to prompt engineering. My personal advice is to use human RAs as a model for how to assign tasks to generative AI. So there is some risk of anthropomorphizing here, of course, but it is useful when you start using these systems that you treat them as if they were interns who are smart and incredibly motivated and eager to help, but completely lack the context of what you're doing. So it means you need to provide context, you need to iterate, experiment, and also at some point you need to be a little bit patient. And the good thing is you can always interact with these systems in natural language. So when in doubt, you can just ask the LLM whether and how it can help with certain things. So what are currently the leading LLMs? Well, at this point, my assessment is that the leading large language model is Anthropic's Claude 3. And as a native European, I said it with some sadness because currently that system is not available in the EU yet. And that means that in some ways there is an intelligence divide. We as researchers in the EU don't have access to the best AI models. And that makes it harder for us to be as productive as those in other countries who do. The second model, unfortunately, is very close, is OpenAI's GPT-4. One thing you can see in this table here is that essentially the top 4 models have been released just in the past 3 months. And actually the 5th line here has just received an update last week. So we now have Llama 3, which was also released in April 2024. and has gotten much better than the previous version. So this just illustrates yet again how fast this is all progressing. A few words on how these systems are trained and what it implies for how I think about them. So the training of large language models proceeds in 3 steps. The first step is called pre-training, and that's really the step that counts most. This is where companies sink huge amounts of money, and that's part of why it is so hard to create one of these frontier models. So GPT-4 reportedly cost more than 100 million. Google DeepMind's Gemini, according to some estimates, cost more than $500 million. And remember, the amount of compute going into these systems is doubling every 6 months. So it means by the end of the year, we almost certainly will have the first billion-dollar model. Next year, $4 billion, $5 billion models, and so on. So what happens during the pre-training? This is the step from which the models have received these monikers, advanced autocomplete or stochastic parrot. The training objective in this step is something very banal, to predict the next word, or technically the next token in any given sentence. And systems are fed vast amounts of data, trillions and trillions of words, and asked to try to predict the next word in any given word, in any given sentence, any given paragraph, and so on, as best as possible. Well, what happens during this process, and this is something that really surprised even the creators of these systems at first, is it seems that the systems learn not only the regularities of the syntax of language, but they also learn to create an internal representation of the world, or you can say a model of the world. Because if you understand the world better, you can better predict the next word in any given sentence. So this is what's in a way behind the power of modern large language models. They have models of the world ingrained into them, and whenever we ask them, whenever we query them for something, they essentially build on that model of the world. And that model is getting better and better and more nuanced every 6 months. And there does not seem to be any clear end to the advances in sight. The next 2 steps are kind of more technical instruction fine-tuning to teach the models to follow the actual instructions we want, and then some reinforcement learning from human feedback, where they incorporate the thumbs up or thumbs down that you can give these models. The next thing I want to emphasize is what are the avenues of accessing large language models? The first avenue is something that I bet everybody on this call has already seen, which is to use them as chatbots, like, of course, the famous ChatGPT. This is the most intuitive, but it gives you only very limited control over the output. And the process that we are currently in, and that I think from my conversations, a lot of central banks are focused on right now, is how to integrate these systems a little bit more deeply into their IT systems, because it gives you more control. So the second avenue, which helps you to do that, are web-based experimentation platforms. Like OpenAI has a playground and so on, and I'll show a quick picture here. On this playground, you can set a number of parameters of the model. They are here listed on the right-hand side. For example, the temperature parameter tells you how much stochasticity is there in the output, and then there are a whole range of other parameters. Google AI Studio is a very similar system for Google's models, but it gives you a lot more control. And then the third avenue of accessing these LLMs are so-called APIs, application programming interfaces. That means you can call these models from within another computer program. If you write code, you can, for example, automatically evaluate thousands and thousands of earnings statements or millions of news articles and so on in an automated fashion using Python code. This allows for maximum customization and integration, but it requires coding skills. But this is where the power of large language models really comes to the fore. And as we integrate these models more and more through our IT systems, we will be able to harness more and more of their advantages and of their productivity benefits. So I'll just flash, this would be like the simplest program for how to get output from an LLM via these application programming interfaces. There are also some risks. One risk is about information security. That's particularly pertinent for central banks because we deal with sensitive data, right? So that means it becomes important to have access to cutting-edge systems in a secure environment. My understanding is that, for example, Microsoft is working very hard on providing access to GPT-4 in secure settings. And I always tell people, well, if you trust them that they don't steal your data from Microsoft Word, then I guess at some level I also have trust in them that the same holds when you use GPT-4 through their servers. There is the risk of hallucination. I think by now we are all very well aware of that. It essentially comes from the fact that these language models, they act in a much more fuzzy manner. They don't act like the computer systems we are used to dealing with from, say, the 1980s, where you have if-then statements, but they act in a stochastic way. And then there's also the risk of bias that we need to stem against. And I believe a risk that will become more and more obvious as all of us are integrating these systems into what we are doing. If we use all the same models, there's a risk of greater and greater homogeneity, something that in the financial sector would lead to systemic risk. And I think that will also be true throughout our economy and society wherever we are using LLMs. Okay, in the next part of my presentation, I want to just briefly highlight some of the capabilities of these language models that are useful for economists. And this is based on a paper of mine that was published in the JEL in December. And the JEL editor was very wise. He accepted the paper only under the stipulation that I have to update it every 6 months, because this field is moving so fast. So since last week, you can access the first update that I created on my website. It is labeled Q2 2024, and that gives you essentially the state of the art of these models as of 2 weeks ago. So what are these models good for in research and in all kinds of activities that we economists engage in? Well, I split their capabilities into 6 categories here. The first thing at which they're actually quite amazing and where you can really see how they are differentiated from the earlier generations of AI systems that many of us have dealt with. These language models are actually really good at creativity, at coming up with ideas, and also at providing feedback. So I regularly ask the systems to, for example, give me ideas about X, or give me feedback on this paper draft. What are 10 ways I could improve? And, you know, even if I take only 2 of the 10, that's really something extremely helpful. So here is a complete list of all the use cases. We don't have time to go through them in detail, so I'll just show you the very first one. Here I asked GPT-4, can you brainstorm 20 channels through which AI may increase inequality? And zoom, it generated 20 channels, some of which I had not thought of before, even though I have been working in this area for a number of years. But the efficiency at which the computer generates them is, of course, really remarkable. And even if just one of these 20 examples is useful for you, that can provide great benefits. The latest generation of language models, they all allow you to upload papers. And here I give an example. Can you suggest ways to improve this paper? And it gave really good suggestions. So I will jump forward. These systems are, of course, really good at writing and increasingly even at preparing slides. So recently I generated a presentation of a paper that I had written, and I asked Claude 3, can you create 20 slides based on this paper? And within half a minute, it spit out bullet points for 20 slides. And that got me 80% to where I wanted to be with this presentation. Another area of capabilities is background research. So this is something where you have to really beware of hallucination. These systems are not good if you ask them for references, because they tend to make things up. But they are very good at summarizing text, comparing two different papers that you upload. Since a few months ago, even summarizing videos, which is a very time-consuming task otherwise, and they can format references, translate text, and increasingly also explain concepts. I will jump through the examples again. Coding is perhaps one of the areas where these language models are the best, because the AI labs creating these models are using them themselves to do their coding of the next generation of the AI model. And so I know a lot of programmers who say their productivity has increased by 100%, 200% or more, because these systems can generate code so quickly for you. And then data analysis is something where they can also be extremely helpful. And finally, there are even some starting capabilities at doing math. This is something the systems were not specifically trained for, and they are not great at it yet. But the most recent generation, like Claude 3, can, for example, already derive you an optimization problem based on some CES production function or CES preferences and so on. So stuff that we would give to our advanced undergraduates. So what are the short-term lessons? In many of these cases that I illustrated, or had to jump over actually, the language models are becoming more and more useful assistants and tutors and allow you to automate microtasks. So that can give all of us some significant productivity gains. I estimate that I'm at least 15 to 20% more productive using these systems. But the problem is that diffusion takes time, and many knowledge workers are behind the frontier, essentially wasting this potential of productivity gains. And as I mentioned, we really need to focus on our comparative advantage to reap these benefits. In the more medium term, these LLMs will almost certainly become better and better as both assistants and tutors, and they are already in the process of being adapted to lots of different use cases. So this will take some time, but it has the potential to significantly change how we conduct research. The current frontier are AI agents. This means systems to which you can handle a task and then they work on it, not just for the next 30 seconds when they generate an answer, but they work autonomously for several minutes or half an hour or even several hours. Eventually, the ambition of these labs is that you can do things like you tell the system, write a paper on asymmetries in the European monetary transmission mechanism or something like that. And the system just works away and a day later gives you some result. What this implies is that the role of us humans in many cognitive tasks will diminish. In many areas, we will turn into rubber stampers because these systems can do it so well, just as we are using calculators nowadays for complicated arithmetic and nobody's thinking of doing it by hand anymore. And I will say that we will all have some deflating experiences as these systems are getting better, and as the bitter lesson that the AI researcher Richard Sutton emphasized in 2019 will increasingly also affect economics. So what was that bitter lesson? The bitter lesson was that as AI systems are getting better, the role for human input as opposed to the AI figuring out things by itself is increasingly diminished. I think I'm towards the end of my time slot now, so let me just jump to my last slide here. So all these advances are amazing. They are giving rise to some deflating experiences, but at the same time, they also raise lots of really important new questions for us as central bankers and economists. And among these questions are the following. What will this new area of cognitive automation imply for technological progress and growth, and things like the natural level of interest rates, inflation dynamics? What will it imply for labor markets? What will it imply for education, geopolitics? And ultimately, I guess our role as economists is always to focus on social welfare. And the good message on which I want to end is that as of right now, our human brains, augmented by these amazing language models, are still the best technology around to answer all these questions. Thank you.
Thank you, Anton, for this great opening. It has been really great. Just as the chat is continuing there were some questions about whether you can get slides, and the answer is yes. And thank you to Nicholas, who actually shared the link before I got a chance to. Couple of questions before we give the floor to John. Anton, when you went over the, like talking about different LLMs, certification or security standard, is the objection there to classify the commercially available options?
I'm not quite sure I understood the question, Deniz. So I
Question
listed all the best publicly available systems, and the top 3 of them are systems that you can only access through the company's servers, so they are proprietary. And the bottom 2, Mistral and Llama, are open source, so that means anybody can run them on their servers. And for researchers, that's a great benefit because you can do this on your own computer, but at the same time, the downside is these open source systems, at least as of right now, are not quite as powerful as all the proprietary systems yet.
Yes. To me, it's clear. I hope it is tomorrow as well. And we had another question on whether research will now become mainly toward innovative idea generation. And we're just going to basically be telling AI, here's a brand new idea, and execution will be left to AI.
Yeah, that's a really interesting question. And, you know, 5 years ago, I would have thought that that is the most plausible path. The problem is right now, it turns out that these LLMs are actually incredibly creative. And we used to think that creativity is something that is uniquely human. Turns out it's not. And according to many measures, the creativity of the AI systems is already surpassing us. So I think we can tell the systems what our problems are, and they will at some point be able to better formulate what the actual research questions are that are useful for us to analyze. But of course, that's still a few years out the horizon. Right now, we still have to hold these systems' hands. We can use them kind of like an undergraduate RA and give them individual tasks, but they are nowhere near being able to go through the whole process by themselves. But I think they will probably be able to ask good questions before they will be able to provide all the answers by themselves.
Right. Thank you very much. I'm sure we're going to continue the conversation with more questions coming in. John?
So thank you so much for having me. I've also been associated with SUERF for a very long time. I think the first presentation I ever did was over 20 years ago. So this is part of a long-standing tradition. This particular work I'm doing on AI is joined with an old friend of mine, Andreas Uterman, who is now at the Bank of Canada, used to be at LSE, and you can find all of our work on this on the links you see here. And I'm just going to echo Anton's words. We created our own, Andreas and I, our own GPD called The Illusion of Control. And I fed into it my entire body of work. And I find it fascinating to see both what it gets right and what it gets wrong. Because even if you give it precise information, it sometimes manages to mangle that in surprising ways. But it's great fun to work with GPT. I know Anton got into it, but the question of what is AI is always a good starting point. And there are the literature on AI has many different views, but we echo one definition coming from the computer scientists that simply sees AI as a rational maximizing agent, which of course to us economists is very familiar, something that gives analysis and makes decisions, which is why it is different from just running an econometric model. AI has, of course, its particular strengths and its weaknesses, as Antoine mentioned. It is really good at finding patterns in large data sets. It is really good at interpolating in what is a very highly dimensional space and therefore finding connections nobody has thought of before. Where it is good, it is fast, it is cheap, it is quick, it is reliable. However, and this is supremely important, the relevant data has to be in its training data set, and that is where AI poses the biggest danger to financial stability, because AI is bad at extrapolating. It might understand the causal relationships in the training data sets you feed into it. However, if it is really to become an effective central banker, not to mention a board member or even a governor, it needs to be able to combine precise information from a variety of unrelated domains, both economic theory, but history, ethics, politics, psychology, and the like. And along the way, it is highly prone to hallucination. And one thing we just don't know for many of the tasks we might ask of it, human beings have set up a very elaborate infrastructure of financial markets, firms, organizations like central banks to moderate interactions. What happens is if when AI starts moderating how we go about our economic life, how does it strategize and how can we incentivize it to act according to our objective and not some other objectives? All of these still remain open questions in the AI literature. Now, the authorities cannot ignore AI, even though I suspect many would really want to, because banks are rapidly adopting AI. And while some say they are not, I suspect many of them are simply not telling us the truth. And they have vast investment in AI. And just to give you one statistics on bank AI use, Bloomberg reported last year that the median salary for a European banker working on AI is over 700,000 euros. So clearly this is a highly competitive market for particular talent, and that boundary becomes important for the authorities. If you are a central bank or a financial authority, AI can do many things for you. It is really good, especially micro-prudential regulations. It can design regulations and rules. It can enforce compliance with them. When it comes to more macro domain, it can advise on stress scenarios. It can implement interventions. If we give it precise objectives, it can find best outcomes. And I suspect within the financial authority, it is entering by stealth regardless of what the official policy is. And something important, and it will do some human beings, of course, are very good at, it is likely to present advice in a way that you can't reject the advice, which means that even though you might think AI is only given advice, well, it might end up being a shadow decision maker. And I suspect it will become very important to the authorities and central banks, no matter what they wish otherwise. When it comes to implementing AI in the public sector, there are 5 conceptual challenges. The first is data. Well, system generates petabytes of data every day, but that data is badly measured, often confined to silos, and the event we care about in macro crises are very infrequent. And so the tendency is we become very good at understanding the system in good times, but not in bad times. And ultimately, financial crises are unknown events. The crisis fundamentals are common. There are only a handful of them, 3 or 4 crisis fundamentals common in every crisis, but the details are always different, because if they weren't different, they wouldn't have happened in the first place, because existing measures would have prevented them. It's axiomatic that crises are unknown events. And then we have to take into account how the system responds to crisis. We have Charles Goodhart's law, we have the Lucas critique, the economists are familiar with, and the reaction function of most agents in the system are not known until we actually hit a stress event. So therefore, the AI cannot simply learn because there is no information to feed to it. In micro, the rule book is known and is mostly immutable, at least on the time scale AI operates. The rule book is not known and immutable in macro, and mutability increases along with timescales and event severity. And if we look at the most severe macroprudential actions, we just don't know what the objectives are, except at a very high level and unusable level of abstraction. For example, who could have prevented how the US authorities or the Swiss authorities reacted to the events of last year? And finally, something we will find challenging is how do we deal with the fact that perhaps the ultimate objectives of regulations is to align private incentives with public incentives. And in that, we have the typical one-sided principal-agent problem. We are the institutional regulator, but now we have a second side to that. AI enters into it, and that upsets the incentive structure in how we regulate the financial system. And when it comes to using AI for official use, there are problems that the computer science literature has identified. And what I want to do here in this list is to map or interact, if you will, computer science vulnerabilities with economic literature vulnerabilities. So to understand those, I think one has to understand both the AI side and the economic side. And the first is how AI can be used maliciously. Of course, the financial system has highly resourced, profit-maximizing agents that don't usually care about social consequences. And AI can help them to bypass controls. They can even change the system in an undetectable way. We have seen many times before when private agents deliberately create market stress to profit from. We can manipulate AI engines. We can use them to find loopholes. And such actions is not only perhaps socially undesirable, but it can be against the interest of the institution operating the AI. So the operator might find that their private objectives don't coincide with everybody else, and they take advantage of that. And as you know, in finance, most common will likely be those that prefer to be on the right side of the law. But AI also facilitates those intent on illegal activities, rogue traders, criminals, terrorists, and nation states. And then we have simply more, perhaps innocuous, but I wouldn't really put it that way, misinformed use and over-dependence on AI. Problem is that when AI does something well, we start trusting it. Problem is we are asking AI now to perform in areas where AI tends to perform well. And problem emerges where it starts to extrapolate to domains where the data is scarce, objectives are unclear, and then AI starts presenting confident recommendations about something it knows little or nothing about. And one can get into that domain because we see it performing so well in something that is less important. And I think the artificial intelligence should have to provide an assessment of the statistical accuracy of the recommendations. And we do know the financial authorities don't like to provide statistical accuracy. And I think it becomes especially important to overcome that reluctance as AI gains traction. Then we have the AI that actually starts misbehaving. That is, how can we align it with the objectives of the institution, and how can it evade control? Well, we don't know if AI will do what it is told to do, just like a human being. We can't pre-specify all the objectives it has to meet. We do know, and there are very good papers showing that AI is very good at market manipulation, market collusion, insider trading. AI can be destabilizing the financial system even when it's only doing what it's supposed to do. And remember, in a crisis, the objective of banks and financial institutions is not profit, it is survival. That is why we get all the flights to safety, fire sale, and investor runs. Is simply the precautionary principle at its best or at its worst. And AI amplifies the forces of instability arising from desire for safety. AI will also find it easy to avoid control. It is difficult to regulate it. The authorities, ultimately, I suspect, will both have to deal with the simultaneous problem of becoming highly dependent on AI and also seeing it helping the forces of instability. And at least our fear is that the second factor will dominate. And ultimately, and this leads into what I'll say next, the more we use the AI, the authorities face an increasingly difficult computational problem, because as we use AI to control the system, the hostile agent that wants to misbehave, legally or otherwise, has a simpler computational problem than the authority, regardless of the state of AI technology, and that divergence can only get worse. Then we have the peculiarity of risk monoculture. Well, we do know from the cloud that the cloud is an increasing returns to scale business, and AI is also an increasing returns to scale business. Well, there's one reason why we have a handful of AI vendors, and none of which are European. And AI businesses depend on three scarce resources: compute, with all the expensive GPUs that have made NVIDIA the most valuable firms in the world; very expensive human capital that is paying vast amounts of money for experts; and data. And the data part is the most interesting. So as we start depending on a small set of vendors for analytics, we start seeing harmonized beliefs, we start seeing harmonized actions, both of which amplify procyclicality and therefore ultimately lead to a higher chance of devastating crisis in the future. And I suspect when the central banks also depend on the same AI engines, as they will and as they are doing now, well, if the AI engine is not identifying the vulnerabilities to the private sector, it's not going to identify it to the public sector. And as the analytics AI business is becoming increasingly oligopolistic, so if you think about who owns financial data, SP Global, the LSE Group are the biggest. And in the past few years, I suspect the authorities have been asleep, but the private sector has been wide awake, because the private sector data vendors have been rapidly merging over the past few years, because the one who owns financial data will also own the AI analytics business and finance. And I find it that it's a big concern to me that neither the competition authorities nor the central bank and other financial authorities have appreciated the potential for increased instability due to oligopolistic AI technology as data vendors have merged in recent years. And if you want to start thinking about how AI should be used in the public sector, we came up with 5 criteria that one can simply apply to various types of applications. Does the AI engine have enough data? Are the rules immutable? Can you tell AI what to do clearly and unambiguously? Does the authority that the AI works for make decisions on its own? Does it interact with other authorities domestically or internationally, or do the politicians take chance? When a mistake is being made, can we attribute responsibility for mistakes? And if mistakes are made, are they catastrophic? And then we can just take all of that together and create a heat map of sorts that maps those 6 criteria for AI onto various types of applications that an authority might end up doing. And I think with that, I'll conclude my talk.
Thanks, Jón. 8 on the clock. So there were quite a few questions coming in as it spoke, but I'm going to say one for more general discussion, but let me raise the other 2. First, you mentioned that AI is, at least in its current form, is bad at extrapolation. But can training be a remedy? Can it be used to get around this problem?
The answer to that is no, because if the training data has the data, you are interpolating, not extrapolating. So extrapolation by definition means we are looking at connections in a data set you have. And one thing, so the issue here is, and it depends very much on the task. In micro tasks, there is no extrapolation as such, or it's minor. So for basically compliance, fraud, micro regulations, risk management, and the like, AI will become really good. For macro, it is different. I mean, if you just think about how the US authorities and the Swiss authorities reacted last year and how the ECB reacted to them reacting, that is, you would not have foreseen any of that, and because it's not in the data set. That information required to deal with the most serious events comes from the key players in the system sitting together around the table, each with their own political agenda, history, objectives, and the like, and a consensus forms, and we just don't know what the consensus is until it forms, and there is no way of predicting that. And that is the extrapolation. The extrapolation problem is really difficult, and especially since the consequences of mistakes in macro regulation are so costly. The serious financial crisis, they cost trillions of dollars for the US and for the Eurozone. So we are looking at making decisions with $1 trillion consequence. And if you get it wrong, you also end up with all the political consequences of political extremism and the like. So this is something we don't want to get wrong.
Absolutely. And one, again, relatively narrow question. As we all know, when it comes to effective supervision, data on operational risk is a huge, huge gap. And do you think AI could provide some solutions there?
AI can, so op risk is, I suspect, is a domain where AI has a potential to become quite good, because we are in a way, if you're combining knowledge that exists within the private sector with knowledge that the public sector needs to acquire, so you're still within the interpolation domain, but you're just adding new training data sets to it. So I would think op risk is generally a domain that AI should be helpful at.
All right, let's give the floor to Sebastian.
So if I may summarize a few takeaways from the last 2 presentations. So in a sense, I guess GenAI can help us a lot in our daily work, but it's not yet ready to be a central banker. And so I think you'll find that theme also throughout my presentation. So GenAI is right now really the center of the debate, but I think it's fair to say machine learning has been around a bit longer. And central banks have been using that for quite a while. So let me maybe provide a bit of recent history and context in central banks before going into the more recent developments. So the Irving Fisher Committee, or IFC, has run different surveys already back in 2015 and also in 2020 to understand, which central banks are using big data, how do they do it, and what for. And so already in 2015, about 1/3 of central banks said that they use big data and machine learning. By 2020, over 80% said they do so. And roughly 40% already used it back then to inform policy. So as you can see in blue here, that's a little bit higher in advanced economies. But I'm pretty sure that if we would run the survey today, and maybe we'll do soon, the number is probably up to 100%. Now, we also asked central banks for what they use big data and machine learning, more specifically. And that's again 2020 numbers. But so as you can see, roughly 3/4 used it in research, which I think is great, and comes back to Anton's point that in research already, Gen AI I think is playing a big role right now. There are also some who use it to inform monetary policy, financial stability, or in subtoken and rectoc applications. And again, the share is higher in advanced economies. Now, central banks have been using AI for a while, but let me give you some more concrete examples of what exactly they do. So, and I think in broad terms, it makes sense to group use cases into 4 broad areas. So one is information collection and statistical compilation. The second one is more macro financial analysis. The third is supervision of financial stability, and the fourth is the oversight of payment systems. Now, there are way too many use cases to go through them. So what this table shows you is just an overview of different use cases by central banks. Now, I'm not going to go through the examples, but just if you want to know more, you can look at our BIS bulletin number 84, which provides a more thorough discussion of all of these use cases. So there we discuss, for example, how central banks use isolation forests to spot outliers in the data they collect. And we also discuss how they use neural networks to break down inflation different components. And increasingly, they also use large language models to digest and analyze supervisor documents. I'm quite sure the next presentation will go into more detail. But again, if you want any more background on that, feel free to read the bulletin, and you can reach out to me or the other authors also afterwards. But let me focus on a few key areas. And I think one important one is AML KYC. So if you want to summarize some of the things that Jón has said, is basically we're good at finding a needle in the haystack, right? So if you have lots of data and tons of events, then machine learning models are really great because they can try to understand what happens and predict where these events will happen tomorrow. And so unfortunately, money laundering is one of those areas where there's lots of data and lots of events, namely money laundering events. And usually these launderers exploit complex interconnections between different institutions and borders. And so our BIS Innovation Hub, the BISI, has a project called Aurora, where they basically have synthetic data which emulates money laundering activities and then compares different models on how they perform in spotting fraudulent activity. And so they compare isolation forests, neural networks, but also graph neural networks. And importantly, they do 3 scenarios. So in one scenario, it's just, at the institutional level, you try to find money laundering occurrences. The second scenario is basically, well, you pool different institutions or the data from them within a jurisdiction. And the third one is cross-border. And so basically what they find is that in general, across all scenarios, more modern models, say graph neural networks, outperform what we traditionally do to spot money laundering. And more importantly, the more data you have, the better they are. So if you just look at one institution, they do better. But if you pool institutions across borders, then the data is really big, and that makes these models really, really good at spotting money laundering. So overall, this really underscores that using machine learning or AI on large data sets in the context of AML can yield large benefits, and that probably is useful in many ways. So one thing we worry about at the BIS is correspondent banking, which is usually high risk, low margin, and has been in decline. And so the hope is that AI could probably enhance AML KYC methods and revive correspondent banking to some degree. Now, granted, these examples aren't really about Gen AI, so let me talk about the new kids on the block. And so I think it's too early to make a statement that is definitive about the tasks for which we as central banks will use AI. But let me tell you a little bit of what we have learned about so far by talking to other people in the central banking community. And so just, the way I think about this is basically LLMs are, in a sense, neural networks. And as Anton mentioned, they're trained to predict words in a sequence of text. And so the important part is to understand context, right? So you want to know whether Rick Deckard went looking for trouble or trouble went looking for Rick Deckard. If you don't know the context, it's hard to understand, what is happening. And if you've seen Blade Runner, both is true, by the way, so the model couldn't be wrong here. But again, the point is understanding context matters. And when transformers came along, that was, amplified a lot in the sense that you could just not only understand context in the same sentence, but really across a huge body of text. And that makes these models so powerful in understanding and creating language. And so based on that, what do we think are really like key benefits of large language models for central banks? And I think one key aspect is the ease of use. So back in the days, which means, 5-6 years ago, when I tried to understand how to convert text data into something I can use to analyze and estimate something with, I spent weeks, if not months, learning to code in R and Python, how I can take the text data, say newspapers, convert the text data to something which is more akin to numbers, how to get sentiment. And all of this was, far away from actually being able to compare different documents. So now I can basically just go to ChatGPT and have it do it, or here at the BS, we have an in-house LLM, so I can just type in, hey, could you summarize for me the tone of the document, and it will do it. And granted, they might make mistakes and it's imperfect, but I think the cost savings are enormous. And, certainly I made tons of mistakes when coding this stuff myself. So I think there's a trade-off here between, AI making a mistake and me making a mistake in coding my own model. And so I think this doesn't just hold for me. Obviously, if you have some basic command of language in many contexts, and Anton gave many examples, you can really use the power of AI to help you, which is, I think, why we have such a rapid adoption of tools like ChatGPT. Now, the second aspect we think is really promising is you can take a lot of unstructured data, especially text, and turn them into structured data. So Jón mentioned the importance of data. By now, the private sector is racing to collect more data. But in a way, central banks have lots of data they haven't really used yet. I mean, we got tons of supervisory reports, a lot of text-based data. And by using large language models to turn that text-based data into something we can actually analyze, that is, I think, a treasure trove of things that still could be done. So just one example here is Project Gaia, for example, at the Innovation Hub, which is using data on company reports and climate risks to get an index that we can use to understand where climate risks are and what risks they pose to financial stability. Other examples are asset embeddings, where basically the next step is to not just use language, which you turn into tokens you can then analyze, but somehow use non-text data, turn into tokens, say investor portfolios, and then have large language models understand that and give you advice. That also holds promises for time series and nowcasting. I think it's still fairly recent, but it's something which we think is quite promising. So, what are the implications of all that for central banks and the work of its staff? And I guess there's plenty of central bank staff in the audience here. So I think panelists have different views here, but so rather than offering you my own views, let me maybe tell you what we learned from central bank employees in different domains. And so, for example, earlier this year, we conducted a survey among cybersecurity experts in central banks, and we asked them about, how do they use AI, what benefits do they see, and what risks. And so I think one key takeaway we found quite interesting is that most experts think that the benefits outweigh the risk for cybersecurity, which is what you see in the left-hand panel. So the vast majority partially or fully agrees that Gen AI brings more benefits than risks. And when we asked them in which way, they gave answers such as, improving threat detection and better fraud detection. So there's clearly direct benefits, but many of the answers were also improvements like code creation, debugging, summarizing documents. And that, I think, squares with, basically what Anton said. There's lots of mundane tasks which take a lot of time. And if you can do them much more efficiently, you have more time for doing the stuff which is more important, fighting cyber attacks. And so I think the takeaway here, it's not that Gen AI necessarily, at least in the near term, drastically changes everything we do in central banking, but we can use it in many different ways to make ourselves more productive and then do other stuff, which is hopefully more interesting, but at least more important. Now, another interesting insight we gained from a different survey among US households squares with that evidence. So in 2024, in February, we asked the New York Fed to add a module to the survey of consumer expectations on how users use Gen AI, what risks they see, and so forth. And so I think in terms of quality, this is as good as it gets in the survey. So if all things go well, there'll be a documentation of that tomorrow coming out, the Bulletin 86. So again, much more information there. So there were a few things we learned from the survey. So the first one is that 50% of households said they already have used Gen AI in the last 12 months, which is an insane adoption rate. So I mean, Anton mentioned that, but I mean, if every second person has used that, that's gigantic in just 1 year. Now, the second thing we asked them is, okay, about your job, what do you say about benefits versus risks? And we were quite surprised by the results. So on the left-hand panel, you see basically that 1/3 of respondents strongly agrees that there's going to be an increase in productivity or new job opportunities thanks to Gen AI, which is very optimistic, I would say, because only 10% think that there are higher risks in terms of job loss or wage loss. So some of our households are fairly optimistic about not being rationalized away in the coming years, and they might be wrong, but at least that's their assessment. But what is striking is there's quite a difference across demographic groups, which would be the middle panel. So for example, men or higher income households or those with higher educational attainment expect greater benefits, while all expect the same risks. And now you can discuss what this means for inequality and to what extent AI will affect different occupations, which we will not do today, but I hope it's at least food for thought. And so by and large, I would say that both households and cybersecurity experts, and I think, also members of this panel agree that there's quite some benefits of AI, which doesn't mean there aren't any challenges, but it's, still can be optimistic, I would say. So I think an open question is at this point to what extent AI will ever be able to fully think and completely replace us. And I think there's vast uncertainty about that, with some people being very optimistic, others more pessimistic. But let's just say we don't know for sure yet. But there are, of course, nonetheless, known problems, including hallucination or the lack of explainability. And as Anton mentioned, I think everybody's trying to make these models better at explaining why they gave a prediction, which for central banks is quite important, right? I mean, if you want to adjust monetary policy to some prediction of an AI model, but you don't know why inflation is going up, is it demand, is it supply, that is not good, right? So you want to understand what's going on. In addition, many countries have laws that require, say, a bank to explain why they denied a mortgage application. So there's a limit to how much you can use these black box models. Another, I think, very important issue, which we haven't talked much about yet, is privacy. So, back in the days, most data was in the hands of the public sector. So we had clear frameworks of how to collect data, who could access them, and so forth. Now I think the vast majority of data is in the hands of the private sector, not in the public sector. And even though much data is seemingly disparate, now with LLMs you can easily combine different data sources. And that, I think, raises new concerns about privacy, data abuse, identity theft, and so forth. And so when we asked our survey respondents, then a huge majority was really worried about these aspects. And for those reasons, also were in favor of regulation. Now, one final nugget, what I found interesting here is that when we asked them, okay, so, who do you trust in safeguarding your data when you use Gen AI models? So most respondents trusted both the government and traditional banks much more than big techs. So there clearly is, if you look at who's providing Gen AI models at this point, there's probably some scope for improvement in terms of the trust people have in big techs. So the providers of Gen AI and how they used it. But so just in all of those challenges concerned, I think it's not important to lose sight that it's probably going to be fairly helpful in the near future to use AI in your everyday context. We as central bankers certainly are fairly optimistic for now. I mean, the BIS has, as mentioned, just rolled out its own internal Gen AI or large language model, which we can now use to summarize text or help us generate ideas for witty text titles, like in Gen AI we do not trust, for example. But let me stop here and see if there are any questions. Otherwise, we can move on. Thanks, Deniz.
Thanks, Sebastian. There's quite a bit of conversation going on in the chat, I could say, and that was the purpose. So we're thank you to all of you for making it happen so far. There's one specific question, so let me put you on that one. The question is whether all central banks using the same AI at the end up inciting upside risks to financial stability. I'm guessing that means downside risks more than upside. And this goes to a little bit what John was also talking about. Is that something that is a question that you looked into?
So we certainly discussed this at the BIS, and I think the assessment is in line with Jón's, right? So micro-pru, I guess AI holds lots of benefits. Macro-pru is a much harder to define issue. And so I don't see central banks basing their macroprudential decisions on AI predictions anytime soon. I think there's much more reluctance to just blindly trust the model on these, say, more slow-moving developments.
Another question, since you mentioned surveys and being interaction with a multitude of central banks on these issues, are there any trends in where these institutions are shifting from hiring economists into hiring machine learning experts or AI experts?
Yeah, I mean, certainly. So the number of, I think, data scientists in the ranks has been going up. I think one takeaway, though, is that ideally you want to have somebody who understands both. So it's good to have somebody who understands economics, but some understanding of machine learning or AI, and vice versa. Because often these things, somehow work together and you have to explain to each other what you want and why you need it. And so I think there's this huge premium on data scientists to have some idea about econ, and that everybody's looking for. That's at least, what we get from informal discussions. And I see Maximilian is nodding, so I guess the ECB has similar experiences.
Yeah. There is another question on the guidelines, whether institutions have, central banks, I'm guessing here, central banks have some guidelines in place that put limits on the use of Gen AI tools. And I know at the BIS, we've been very cautious, our IT colleagues, but more generally.
So, I mean, I don't know more than you do, Deniz. We're in the same institution, right? But so I initially thought, so I think the main concern right now is still privacy, right? So we don't want to have internal documents being uploaded to some Gen AI and then we don't know what happens to them. I think that's the key concern right now in terms of guidelines. I did think we were fairly slow moving, but in hindsight, I don't think so. I think most institutions are very cautious because, okay, we trust Microsoft with Word. I think that's a very good example. But still, you want to make sure that everything is done in a kosher way. And so I think privacy for now is the main concern. I think the worry about us using the same models and then, you're deciding to rescue a bank which doesn't need rescuing, I think that's a second order concern for now.
Yeah. Right. Thank you, Sebastian. Maximilian, thank you for your patience. We're very excited to now hear you tell us from the ECB perspective where things are.
Sure. Good afternoon, everyone. Let me thank Ernest, let me thank Deniz and the other organizers for inviting me to this event. It's a great pleasure and a privilege to share some insights on AI applications and governance at the ECB. I think what I'm going to present kind of zooms in a little bit on what has been discussed in more broad terms by Anton, Jón, and Sebastian. So I hope it will provide additional insights. I also think that the discussion comes at a very good point in time. Of course, AI is the topic of the hour, while, as Sebastian already pointed out, a lot of applications was already there in central banks. So it's not entirely new to us. But I think the current hype that we are seeing, particularly, of course, induced by the advances in the LLMs, is a super opportunity to look on the one hand, of course, on how we can use AI to become more efficient and more effective in performing our tasks as central banks. So answering a little bit to Anton's comment that we need, as public institutions, reap the benefits that AI presents. But also, on the other hand, take this opportunity to discuss limitations, costs, and risks that maybe Jón was referring to a bit more. And I think we're doing so. I'm actually talking to you from from an innovation forum that is taking place in Paris in the context of the European system of central banks, where exactly these topics will be discussed. So in a sense, I mean, in many ways, all I have to say, or most of what I have to say is presented in this slide. I think there are kind of three broad areas through which AI is affecting the way central banks work. One is the kind of indirect effect that AI will or already has on the financial and real economy, all its opportunities for new products and services, but also, of course, the risks that some of which have already been discussed here. And as a consequence, all of this will have an impact on the way we do monetary policy. And then there's, of course, in day-to-day business, two more direct ways that AI is already and will increasingly impact our work. One is, and Sebastian already showed some use cases, I will do so as well, how central banks can use this new toolbox for economic analysis. And then on the other hand, very practically, there's of course also a lot of ways that AI can help us make our business processes more efficient. And in the following, I will touch on all of these three areas very briefly, and then close with some more concrete comments on AI strategies and governance at the ECB in particular. So let me start with AI implications for the economy. And here I'll be very short. I'll be short for one thing, because Jón already covered, I think, a lot of the financial stability concerns that are arising, but also because in many ways it's a little bit too early to say, right? What I can summarize talking to experts in the European Central Bank is that generally, and a snapshot, so to say, at this point, we assess the impact of AI on the economy as being positive. Positive because we see a positive impact on employment. So AI so far is complementing jobs rather than substituting them. And of course, we also see and expect further increases in productivity. I mean, taking the impact of digitalization more generally on prices, we also expect a disinflationary effect of AI over the medium and long run. And again, you know, based on the views of the experts in the ECB at the moment, we don't see large negative consequences on financial stability yet, one has to say, but there's certainly growing concerns, and I think that those were already quite well reflected in the presentation of Jón. Now the problem is that, of course, in terms of rollout of AI, particularly general purpose AI, we are very much at the beginning. And we really don't know what will happen if these tools are more widely adopted. We don't know what that's going to mean for financial stability. We don't know whether there will be more significant or significant disruptions in the labor markets. But we also don't know what will mean for inflation in the long run, because on the one hand, we might have disinflationary effects of new tech. But, and this has also been mentioned already today, there might also be market concentration tendencies on account of AI, but also options, for example, for price discrimination, which might have the opposite effect. And it's not entirely clear which of these effects will prevail. So, our line at the ECB is that we will continuously and carefully analyze the impact of AI on the medium-term economic outlook and the transmission of our monetary policy, but also consider financial stability consequences. So I'll keep it short here and move on to economic analysis and provide you with a couple of use cases, particularly in DG economics, where I'm based. But I think they complement nicely also the use cases that Sebastian already mentioned. I mean, I think also from what has already been said, the obvious application of AI is, of course, forecasting, because the machine learning models we have are very, very good at detecting patterns in data. One of the challenges that maybe central bank forecasters have been facing over recent times, and it's also been in the media quite a lot, is of course that that there were a lot of shocks in recent history over the past decade or so, more than we've seen in the decades before. And this implies non-linearities that our standard forecasting toolbox of linear models are maybe less well equipped to handle. So here's one use case of colleagues in DG Economics and research that use quantile regression forests to assess, to forecast headline and core inflation. And what they find is that these models can compete quite well with state-of-the-art linear forecasting models, but also with what we see in terms of forecasts from professional forecasters. They do not, or maybe not yet, systematically outperform our current toolbox, but the feeling is that they are becoming an important additional element in our toolbox to forecast short-term inflation. I've also shamelessly included some analysis I've been doing myself on event prediction. So what we've done here is try to replicate a paper by Helen Ray and co-authors that used machine learning to predict financial crisis. We've tried to replicate this for financial crisis. What colleagues in the IMF show is that these types of models outperform standard logit or probit regression models in forecasting these kinds of events. And this is also what we see focusing less on kind of the global prevalence of these fiscal crises, but zooming on a little bit on the advanced economies. Not all country cases look as nice as the Greek one that I put in this slide, admittedly. But again, our feeling is that these kind of tools are an important addition to our early warning toolbox, not to be taken at face value, but if we see in these tools a spike in crisis prediction 1 or 2 years ahead, that is, of course, then a very good reason to take a little bit of a closer look at that particular country. Another nice application, which also links to the BIS Innovation Hub, is the work that colleagues are doing on daily price data. So they're using LLMs to categorize the information that they got from web scraping price data. And what they can show that using this kind of data significantly reduces our nowcasting errors in predicting inflation. And I think they're working now on moving ahead with also implementing GPT and assessing this web scraped data. And then maybe very briefly a fourth example also of my own, where we use LLMs to analyze central bank communication. So what we do more specifically is to look at policy interaction in central bank speeches, so references of central bankers not only to monetary but also to fiscal and financial topics. I think the innovation we have in this paper is that the standard approach, particularly in the sentiment analysis literature, was of course to do word count, to count the number of words in speeches that have some positive or negative connotation. We try to have the LLM actually extract context and see whether it can detect instances of monetary, financial, or fiscal dominance in the speeches. And it does quite well. I mean, it's not an easy task. And actually the economists that were working on the validation set did not always agree on the classification of sentences. But if we take the average of the economists working on this validation set, then the LLM, so the GPT 3.5 gets about 60% right. And then with GPT-4, we're actually up to 80%. So that's, given the difficulty of the task, I thought that was a very interesting result. Okay, third area of application of AI are the business processes. Maybe here to mention that for the ECB, this could be particularly relevant, maybe even more relevant than for other central banks. Why? Because on account of the federal nature of the Euro system, we have a lot of interaction with national central banks. Ernest, as a long-standing member of the MPC, might remember all the procedures that we have in place. But the ECB is, of course, also a member of EU Council and committees. So we are currently testing a lot of possible applications of AI to make our work more efficient. I mean, I list a number of areas here that I won't go through in detail, but I think one very simple example is to have an LLM that has as a training data our information repository and can, when prompted, respond with information from our repository, which is currently still a little bit tedious to find information in using the kind of standard search functions that are available. But also stuff like meeting summaries or summarizing written procedures, surveys. We run a lot of surveys summarizing those. I think there's a lot of applications that we're currently looking into, hoping that we can make our work more efficient. So let me close with some information on our strategies and governance. I think there's broad agreement at the ECB that adopting AI more intensively, more widely than we are currently doing has vast potential in terms of improving our ability to do economic analysis, but also particularly, of course, on the business process side, to save resources. On the other hand, we are very, very aware of costs and risks. I mean, I think one thing to keep in mind is that implementing these new technologies is not costless. No, I mean, there are transition costs, there are training costs, there's also IT related costs. And I think in this context, making sure that the priorities are set right is very important. Then the operational risk, particularly with regard to data protection, I think have already been mentioned. I think it's also important to keep in mind that there's a risk of falling behind. That if we don't work on this now, there's of course risks not only to our reputation but also the quality of our economic analysis going forward. What we did, at least in DG Economics, with regard to kind of accounting for these benefits but also costs, is adopt this kind of broad strategy. It's a bit stylized, of course. But in the first three steps, the idea is to kind of build the knowledge base of staff, strengthen collaboration both within the ECB across directorates general, but also beyond the ECB in the Euro system and beyond that even. And then encourage researchers and staff working on business processes to try out stuff. And only then, kind of after we've tried things, to then set priorities where we really want to invest and adopt, roll out AI to reap the full benefits. Maybe just to also show you kind of the way we are set up in implementing these AI applications. There's on the one hand, of course, the issue of risk assessment and mitigation. There's a number of committees and bodies within the ECB that looks into this. Admittedly, personally, it's always a bit tedious. I'm always unhappy if things are held up because of due diligence, but I of course see that this is necessary and required. There's the collaboration that I already mentioned with the SSM, with the national central banks, but also beyond that. And then there's, of course, all the support areas that are of critical importance to get this off the ground. There's information systems that really act as a hub and are very, very helpful in providing technical support to the projects that we are launching. There's human resources that works on identifying and addressing the knowledge gaps we still have. There's statistics that we already mentioned how important data is. It's working on developing, maintaining, but also checking the quality of the data we use. and then the secretariat that is working on the business process side a lot in developing tools that allow us efficient data management. So I'll close with kind of the main takeaways of my thoughts on this. One is that it's maybe still a little bit early to really draw conclusions on the broad macro financial implications of a wider AI revolution as we're currently seeing it, maybe for central banking. That second, we expect really a lot of leverage from these tools for our analysis, and potentially also significant resource savings, and that we're carefully trying to weigh all these benefits against the possible risks and also the costs. And I'll close here. Thanks very much.
Thank you very much. It's been a good way to close it all, bring it together on a practical front as well, I'm guessing. Now, one question that was being discussed in the sideline was whether it would be recommended to use AI for pricing difficult to price securities, illiquid bonds, for example. What are the risks would you see from there? Maybe Jón, you want to?
Sure, I'm happy to jump in. I see a lot of problems with trying to price securities for which you don't have any information to price. What you're really saying is the reason why these bonds are difficult to price, because we don't know enough about the factors that drive those bonds. And that just means you're lacking the basic information on what will happen in the future. So bonds, they will react to a future political regime. They will government decisions, fiscal positions, years and decades into the future. The present value reacts very strongly to even small changes in the discount rates we apply to those bonds. So therefore, AI cannot create information out of nothing. And there is a belief somewhere that because we have AI, we learn more about the world than we actually do. That is true, but only to a certain extent. AI is really good at finding connections we don't find in existing data. So therefore, to that extent, it will help to price these illiquid bonds, but it does not create information out of nothing. And I think recognizing those bounds will be very important for anybody using AI going forward.
Thank you, Jón. Any of you want to weigh in? There are plenty of questions. I can go on. So there is another question about whether using Gen AI for monetary policy decisions is already something happening or would be advisable. Anton?
Happy to give my 2 cents on that. So my understanding is that when we really speak of generative AI, we are talking of large language models mostly. And these language models, they are incredibly helpful with language. So the main use case for monetary policy is that they can help you to parse the public statements and detect fine nuances in the text. They are not really analytic tools. For that, the more like deep learning based older AI systems in the style of the 2010s are actually much more useful. But my understanding is that we haven't made all that much progress yet in integrating them into our macroeconomic models, although many central banks around the world are making efforts to do so.
Can I just add a little bit to that? I just want to echo what Anton is saying is, I almost think the discussion on AI is too dominated by LLMs. Because if you look at the literature on AI, LLMs only, it's the most popular subcategory. But there are, just to give one example that I look at in my work, is we have adversarial models where you have different AI engines competing against each other in a way that LLMs don't. And that sort of environment might be much more useful in a lot of regulatory and monetary policy environments. So in a way, there's a risk of us becoming excessively focused on LLMs and ignoring the rest of the AI universe.
Deniz, if I may, I mean, I fully agree. When we did the survey among central banks and got the use cases, you know, almost 99% were non-LLM Gen AI use cases, even though AI is everywhere. But even, you know, older models like random forest can be very useful in many contexts of spotting outliers. So I also think we're focusing maybe too much on the present hype and too little on the other methods.
If I can also come in, maybe one application, of course, that comes to mind, and because it's about language, is of course the whole sentiment analysis issue. No? So if you are, I mean, the daily price data project that we're doing together with the BIS, of course, is one example. But also, you know, you could use LLMs to extract from news articles, for example, sentiment. And rather than using this, of course, as an instrument to decide monetary policy, this could be something that generates data, no, on the basis of which decision makers in central banks can then improve their decisions.
Indeed. Max, let me ask you another question that Ernest actually raised. And Sebastian mentioned this proprietary Gen AI we have at the BIS. So not feeling quite comfortable with confidentiality and other proprietary data type of issues. BIS IT is developing its own tool, if you would. Is that also something ECB is doing?
This is in a sense the elephant in the room for us at the moment. No, so there are many possible applications of AI in the day-to-day work of the ECB. I gave you a list which is probably not even encompassing. For stuff like you know, sentiment analysis in newspapers, of course, there's no big issue because it's public information that we simply extract, condense, create new data. But for other things, you know, summarizing confidential meetings or feeding the model with be it data, whatever form of data, no, text or numbers that are confidential, we of course have a big problem. And this is something that we are looking into very carefully now with all the different actors within the ECB. So the colleagues in information system, in the data office, in the risk assessment committees, to try and find the right balance. Because if you, of course, completely block this kind of technology, you're left, of course, with LLMs that are run locally. Anton might be able to provide more detail, but my suspicion is that they will by far not be as good in terms of quality as the proprietary ones, but they will also be very costly to maintain, of course, for the institution. So to get the balance right, on the one hand, making sure that confidentiality concerns are addressed, on the other hand, allowing us to use the latest technology available is really the kind of the difficult path we're trying to walk.
If I may add, this is really a huge deal because the gap between the best systems and the ones that you can run on your own systems is tremendous. And you will soon be dealing with a financial sector that's very much teched up at the frontier with the smartest systems out there. And central banks will be behind if they don't have access to the same. So this really concerns me because obviously central banks should also worry about safety.
Indeed. Perhaps a related question that was in several audience members' mind is the human capital part of it. So central banks need to be on the forefront there as well. And what are your views on the recruitment tools? Where should be the focus of central banks and how can they compete in that market with private institutions, other public institutions? Who wants to go first?
I'm happy to. What?
Please.
Anton had his hand up first, maybe.
No, I don't want to monopolize. Please go ahead.
Okay, no, every time I talk to students, the 21-year-olds, this particular question comes up, and I always give the same answer to the students. And I want to come back to what someone said earlier in this conversation, is that I think what we are now seeing in the skill sets market is we almost requiring a higher level intelligence for the same, or higher level human capital for the same job function. So the 22-year-old now that is entering the job market, in 5 years' time, they'll be running against someone who they'll be competing with somebody in the job market, and the person gets promoted is someone who can both speak AI and knows the business model. And I think some of the previous speakers echoed that as well. So we need people who have a dual ability. They can both do AI and they can do economics, or they can do finance or monetary policy. And we have to recognize we are asking for a lot more of a human being than someone who can only do data or only do economics. And this is why, as I said earlier, the median salary for a European commercial bank AI specialist is north of 700,000 euros last year. And the central banks almost risk, so there is one problem I think the central banks might face, which is that all the people now who are doing jobs that will be taken over by AI, what will those people do in the future? And we might say we are all going to do much more productive, better things, but all the people who were filing clerks 50 years ago, when the computers took over, some of them made the transition to computers, but some of them did not. So the human capital cycles the central banks are about to face because of AI will be very, very difficult. And I would suggest they be very proactive in anticipating the recruitment cycles and employment policies, because that problem, I suspect, will be much harder than anything they've faced so far.
Anton?
Yeah, so as both John and I observed before, we should really distinguish between these two categories of AI, the traditional analytic-based AI and the large language model, generative AI. And we need two kinds of people with two different skill sets for these. So for the analytic AI, we need a small set of people who can create and maintain them. And actually the generative AI is so good at programming that the number of people we need for that is declining. And then we need essentially all our workforce to speak AI to be able to leverage the generative AI and be as productive as we can be. Now, that does not require programming skills. It requires following the issue. And the good thing is that all of us can learn this, although it does not come automatically. It takes some nudging. It takes a lot of experimenting. And what I have observed is that there is actually a huge age gradient. The young 20-somethings are excited to experiment with these tools, but the excitement declines in age, and that's also a little bit concerning for me. Now, in the more medium term, one thing we have to grapple with is that a lot of our human capital is becoming devalued by these systems, because these systems can make anybody an expert in anything, and as they're getting better, the human capital we now have may not be quite as much worth as it is.
Exactly.
If I may come in, Deniz, as well. I recall that having a beer with Jón, I think 15 years ago at LSE, he was telling me that the problem with public institution is that they get all of his bad students, while the good students run off to become investment bankers or other high income earners in the private sector. I don't know if it's that bad. But speaking from the ECB perspective again, I think our strategy now suggests kind of a two-pronged approach. The one is the training of staff that has little exposure to AI so far, and the other is recruitment. On the training, we're still in the process of adopting a strategy there, but I think what we're going to do is very close to what Anton also suggested. So to have kind of a broad base, to get almost all staff on board to be able to operate LLMs, for example, for daily tasks. And then kind of in almost like a pyramid system. On the other hand, kind of go more narrow and more deep as skills are then required for economic analysis and machine learning and so on. On the recruitment side, I mean, what I see is that young colleagues, or particularly also trainees now, they all have basic knowledge, even more in AI. So I think in a sense it will come naturally that the young colleagues are, just as people coming from graduate school 10 years ago were naturally DSGE or econometricians, experts in DSGE or econometricians. They now have, in addition to their economic background, basic or even more understanding of these tools. But I think we do have to think as central banks whether we can go beyond the standard recruitment tools to identify really talent. And I know that, for example, Banque de France has interesting hackathon approaches to try to recruit young talent to their institution. And I think within the Euro system, we should think about similar mechanisms to identify the talent that we need in future.
I mean, so the talent you need is the big question, right? So I mean, as Anton said, it's one thing to understand how to code transformers and really, be able to join Google and write AI models. But think of data, right? Okay, 15 years ago, you had to code your own clustering of standard errors and you had to understand all this matrix multiplication. And now I think you just go comma, whatever, VCR cluster X, and things work perfectly fine. You just trust it. And 99% of the economists get by with that wonderfully. So I think it's okay to understand the intuition behind things. I'm not sure we need that profound knowledge in understanding these AI models as central banks necessarily. I mean, if we decide to build our own models, then probably yes. But if that's the route to take, is I think an open question. Doesn't mean you shouldn't have some idea of how to use it, obviously. But I'm often a bit hesitant of just going out and hiring 1,000 data scientists, because it's not really what we do at central banks as a day-to-day business. But that's just me.
If I could just respond a little bit to what Sebastian was saying, I very much agree with you in what you said, but there's one particular concern, which is that as we start using AI for decisions, will the senior people who are taking the output from the AI system, will they understand the strengths and the limitations and be able to integrate it into their way of deciding? I am more worried about the senior decision makers than the juniors in the authorities.
But I don't know how the ECB is doing it, right? The BS doesn't set monetary policy, so I don't think we really have a choice in setting rates. But when you communicate upwards, at some point you're back to a scatter plot anyway, right? I mean, so I'm not sure if you spend 3 years in the cause identification and nailing some small effect, if that goes all the way through the ranks. So I think there's already some disconnect between things we do further down the ladder and what transpires upwards. So that doesn't mean the AI issue isn't a different one we have to understand, certainly. But I'm not sure if the problem is that new in some respect.
No, of course it isn't. It's just a new risk factor I'm highlighting that might emerge. I mean, it might not mean anything, but the risk does not mean something will happen. Risk is something one should think about because it might happen. And I think these type of discussions is quite a lot of it is not about what will happen, but what we should think about so we can anticipate the problems of the future.
Yeah, absolutely. This is a very insightful discussion. Also reminded me some of the discussions that took place after the GFC. As you may remember, there was this theory of physicists being hired to price certain securities without understanding how humans are motivated, without understanding economics, if you right, and finance. So obviously, we shouldn't repeat the mistake, as Jón said. It's about what might happen, what might be the gaps. We have about 10 more minutes, so let me pick your brains on one last question that came up. And that's about what central banks should do with their supervisor or regulator hat on. And John, particularly after your presentation, everybody, of course, understands the risks, but then the obvious question comes, what should we do? What type of solutions we should be looking at? Should there be limits on what private sector can use when it comes to Gen AI tools? Or how should we design regulation using Gen AI tools that would address some of the risks that you raised? But more broadly also, how should central banks think about the changing economy? Anton went over quite a bit of different channels, right, from labor markets to competition that came up. So how should we integrate that into regulations and monetary policy decision making as well?
Okay, I think you were directing this to me, right? Or
please, you get started, because
okay,
I get raise more flags.
I mean, the problem is we could do a whole conference on exactly that question. So in a way, it's a bit unfair to do this at the very last second. If I were thinking about the micro rule book and not the macro rule book, I would almost ask the follow-up, because A, we do know that the private sector firms are all jumping into it, and B, we know they don't talk about it. Right, so I would just want to figure out what exactly are they doing with AI. I would also ask the question, how can I take the rule book and translate the rule book into a local AI engine running in an authority? So this is perhaps where one of the local LLMs could have a role, but there are techniques for translating logic engines like a rule book into something more formal, and then we can see how that evolves. So in a way, formalizing that process, and then trying to figure out is the regulated interaction, which there are ways to model within the AI literature, but not with LLMs. So one can, in a way, formalizing that process would be one of my immediate suggestions to at least any micro authority thinking about AI.
It is a very, very involved question. I didn't mean to leave it to the end, but there we had a lot of things to discuss. Anton?
Yeah, happy to continue. I want to start by observing kind of what central banks have to take as given from the external environment. And I think the external development will be that the private sector will roll out these AI systems wherever they are profitable. And depending on how fast their capabilities are advancing, and right now that is very fast, but obviously predicting that into the future carries some risk. That means that we will see this adoption really fast, and private organizations will, to just use that word that comes from artificial intelligence, become more intelligent by integrating these tools. And so what does that imply for central banks, financial regulators? They will have to deal with these rapidly more intelligent entities interacting with our financial system. When everything goes well, this means greater productivity, and it really benefits everybody. But of course, I think that's where Jón put his emphasis, and he did so rightly. It also means that the risks are rising and are becoming larger. So in some ways, if you look at the evolution of our financial system, and I'm working on a project on that with some of Sebastian's colleagues at the BIS right now, then you can kind of say that integrating better and better computational tools into the operation of the financial system has kind of been the thing since we had the first financial transactions in Sumerian times. And nowadays we have AI agents that automatically execute lots of trades and so on. We have financial institutions that use AI systems to score credit, but we have always incorporated our most advanced analytical tools into the financial sector because, well, that's where the money is, right? And that's why it attracts the most advanced intelligences. And the same will happen with our most advanced AI systems. So the challenge for central banks is to facilitate that integration and to keep up with it in their role as both stewards of the macroeconomy and financial regulators. And it will have repercussions for both of these aspects. I'll also say that, of course, the financial sector is not the only sector dealing with this problem. And there is a wide set of standards and risk management frameworks for AI that is being developed by institutions like NIST, by institutions in Europe, by the ISO. So there are broad standards that are useful for the financial sector, just as they are for other sectors in the economy. And we dealing with, for example, financial risks, we don't need to reinvent the wheel for those, but we can also resort to those existing standard systems, risk management frameworks, and learn from them and make sure that we integrate the values when it comes to these systems being ethical, being unbiased, being safe, and so on, being under human oversight, so that we can integrate those values into our job of overseeing financial markets and managing the macroeconomy as well.
Absolutely. Any other last thoughts? Ernest?
I've been faced over the past couple of years with ever-increasing cautiousness by IT people who run the central bank systems, being very cautious about cyber criminality. And this is really getting very far-reaching. I think in central banks, we really will face a very severe tension between the fear of data safety and the need to stay on top of the technology. This will be really a tension which will be difficult to resolve.
I'll just say it is indeed one of the central tensions. And the easy path would be to say, let's just be cautious and go slow on everything. But I think in the long run, that would actually be the more dangerous path, because central banks would fall behind, and the private sector is not engaging in the same precautions and doesn't have the incentives to do that. So there are lots of technical tools for making these systems safe from an information perspective. It takes time and effort, but I believe it's worth it.
I always wonder if a central bank, because this is an old question. I mean, I remember I was asked the same question in a central bank over 20 years ago, long before AI. And of course, every commercial enterprise has the same question. So central banks are not unique. Everybody has the same question. I always wonder, if you want to do frontier research on something, why not just create a completely segmented network that where central bank researchers can work with state-of-the-art techniques and data you are more relaxed about not leaking, rather than trying to do everything inside the network as it is.
Maybe to add to you, I think it's a very good point. Now that we could try to create more of these safe sandboxes to do analytical work. I think the other thing I've been thinking about, also discussing a lot with the IT colleagues, is that there's, in my view, two instruments to handle this. One is, of course, regulation, to kind of stop us using or only use under certain conditions these new technologies. And the other is getting our colleagues informed about the risks. And my personal view, but this is maybe not the view of the ECB, my personal view is that the latter approach is probably the better one, or that if we get everybody up to scratch in terms of internalizing the risks that this technology carries with it, that's probably the best insurance that we can develop.
Thanks to all speakers for your time, for your insights, and until next time, that's what I'm going to say. Thank you, everyone.
All right, thank you very much.
Thank you.